Well, first, it's crucial to understand the basics. Let's start with stocks. When you purchase a stock, you're buying a small piece or share of a company. This gives you a claim on part of the company's assets and earnings. Next up, we have bonds. These are essentially loans you make to a corporation or government. In return, you receive interest payments and eventually the return of the loan amount or principal. Then there are mutual funds. These investment vehicles pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other assets. Lastly, we have exchange-traded funds or ETFs. These are similar to mutual funds, but they're traded on stock exchanges, just like individual stocks. Each of these options carries potential benefits and risks, and it's important to understand these before making an investment. After grasping these fundamentals, you're ready to delve deeper into the world of investing. Now that you know the basics, it's time to discuss something vital in investing: risk management. This involves taking strategic steps to minimize potential losses while maximizing your returns. One of the most effective ways to manage risk is through diversification. This means spreading your investments across a variety of asset classes, such as stocks, bonds, and ETFs, to balance potential losses in one area with gains in another. Another key risk management strategy is asset allocation. This involves adjusting the proportion of each asset in your portfolio based on your risk tolerance, investment objectives, and time horizon. For example, a younger investor with a high risk tolerance might have a higher proportion of stocks, while an older investor nearing retirement might prefer a greater allocation to bonds. In essence, risk management is all about balance. By properly diversifying and allocating your assets, you can better protect your portfolio against market volatility and enhance your returns over time. Remember, managing risk effectively is a key component of successful investing. You've got the basics down, you understand risk management. Now it's time to roll up your sleeves and get into research and analysis. This is where the rubber meets the road in your investment journey. You see, before you decide to buy shares in a company, you need to know what you're getting into. Start by researching the company. Look into its past performance, its leadership, and its competition. Don't just focus on the numbers, but also try to understand the story behind them. Next, dig into the financial statements. These documents can give you insights into a company's profitability, its financial health, and its growth prospects. Look at the income statement, the balance sheet, and the cash flow statement. Lastly, evaluate the company's performance. Compare it to its peers, industry benchmarks, and its own historical performance. Remember, no company operates in a vacuum. It's always in relation to something else. Conducting thorough research and analysis can help you make informed investment decisions. Investing is a marathon, not a sprint. Let's talk about long-term investing versus trading. With long-term investing, you're in it for the long haul. This approach is about buying and holding investments for several years, focusing on steady wealth accumulation. It's like planting a seed and patiently waiting for it to grow into a mighty tree. On the other hand, trading is a short-term strategy. Traders aim to take advantage of quick market fluctuations to make profits. It's similar to a day at the races, where speed and timing are of the essence. Each approach has its pros and cons. Long-term investing generally involves less risk and requires less time, but patience is key. Trading can offer quick profits, but it's riskier and requires constant market monitoring. Ultimately, your choice between long-term investing and trading should align with your financial goals and risk tolerance. Whether you choose to be a long-term investor or a trader, always remember to stay focused on your financial goals. There's no one-size-fits-all strategy in investing. Let's explore some common investment strategies. Firstly, we have value investing. This is all about finding and buying stocks that you believe are undervalued by the market, kind of like buying items on sale. This strategy requires patience and a good understanding of company fundamentals. Next up is growth investing. Growth investors seek companies that are expected to grow at an above-average rate compared to other companies in the market. This strategy can be a bit of a roller coaster ride with highs and lows, but can also provide substantial returns. Lastly, we have dividend investing. This strategy involves investing in companies that regularly pay dividends. It's like having a steady stream of income, which can be particularly attractive for those seeking a more stable return. Choosing the right investment strategy depends on your individual goals, risk tolerance, and investment horizon. Investing without clear financial goals is like sailing without a compass. Let's discuss the importance of setting financial goals. You see, the journey to financial success isn't a one-size-fits-all path. It's unique for each of us, tailored to our individual financial objectives, risk tolerance, and time horizon. And how do we create this personalized roadmap? By setting clear, specific financial goals. This is where SMART goals come into play. SMART stands for specific, measurable, achievable, relevant, and time-bound. Specific and measurable goals help us track our progress, while achievable and relevant goals ensure we're setting ourselves up for success. Time-bound goals, on the other hand, keep us on track, pushing us towards our financial milestones. The beauty of SMART goals is that they guide our investment decisions, helping us choose the right investment strategies, assets, and risk levels. Remember, successful investing starts with setting clear and realistic financial goals. Ever heard of the term market psychology? It's more important than you might think. It's the emotional undercurrent that drives market trends and influences investment decisions. Now, let's talk about behavioral biases. First up, we have confirmation bias. This is when we only pay attention to information that confirms our pre-existing beliefs, ignoring anything that contradicts them. To avoid this, always challenge your assumptions and consider all relevant data. Next, there's herd mentality, where people follow the crowd instead of making independent decisions. Remember, just because everyone else is doing it doesn't mean it's the right choice for you. Lastly, let's discuss loss aversion. We often fear losses more than we value gains, which can lead to irrational decisions. To combat this, focus on your long-term financial goals and don't let short-term fluctuations sway you. Understanding market psychology can help you avoid costly mistakes and make more rational investment decisions.